Welcome to this explainer. Today, we're breaking down a fascinating and, well, pretty alarming topic. We're talking about money laundering, but absolutely not the way you see it in the movies. No duffel bags of cash in dark alleys here. Instead, imagine billions of dollars quietly vanishing right onto the world's most legitimate trading floors. It's basically the ultimate financial magic trick, and today we're going to reveal exactly how that illusion actually works. Okay, let's take a quick look at our roadmap. We're going to redefine the threat, see exactly why global markets are the perfect hiding spot, unpack this illusion of legitimacy, break down the actual trading tricks criminals use, and finally look at how the industry can actually catch them. Let's dive right in. Section 1. Hiding in plain sight, the new face of financial crime. So, the Financial Conduct Authority, in their 2025 review, actually gave this specific threat a name. They call it money laundering through the markets, or MLTM. The gist here is that instead of using sketchy shell companies to buy real estate, bad actors are using complex securities, derivatives, and institutional trading accounts. Why? Well, the goal is to make dirty money look like a brilliantly executed, perfectly legal stock trade. And as the FCA points out, as financial products get more and more complex, this threat is literally skyrocketing. Moving on to Section 2, why criminals love markets and why these massive networks provide the absolute perfect environment for illicit funds. The Financial Action Task Force, FATF, points out that capital markets offer exactly what a launderer dreams of. We're talking volume and speed. I mean, when millions of trades happen in a matter of milliseconds, illicit funds can just vanish into a massive sea of data. Add cross-border access and layered intermediaries, like brokers and clearinghouses, to the mix, and the money becomes practically untraceable. But you know what the most dangerous vulnerability is? Plausible commercial explanations. The trades just don't look suspicious because, on paper, they actually make economic sense. Now, if you know the classic money laundering playbook, placement, layering, and integration, well, it gets a massive institutional upgrade here. A criminal might place funds by buying standard fixed income products. Then they layer those funds by executing these dizzying cross-market trades across multiple jurisdictions, bouncing the money between incredibly complex custody arrangements. Finally, the funds are integrated back into the real economy. If the authorities come knocking and ask where the money came from, the criminal just points to a clean, totally defensible paper trail of supposed trading profits. Section 3. The illusion of legitimacy. Let's look at why this specific brand of financial crime is so incredibly hard to spot. Here's the thing. If you try to take retail banking controls and just copy-paste them into capital markets, it's gonna fail completely. Think about retail banking. There, you're looking for obvious, glaring anomalies, right? Like someone walking in and depositing exactly $10,000 in physical cash every single Tuesday. But in capital markets, shifting massive amounts of funds across borders and using layered corporate structures isn't an anomaly at all. That is literally the everyday intended purpose of the market. And that brings us to absolutely the most crucial concept to remember today: plausibility. Criminals in capital markets aren't just stuffing dirty money in a vault. They are actively manufacturing a credible explanation for their wealth. They are constructing a rock-solid origin story for the money, one that perfectly mimics ordinary market growth and can easily breeze right through a casual regulatory audit. Section 4. Tricks of the trade. So, how do they actually pull off this illusion without tripping all the alarms? Regulators like FINRA have highlighted some very specific red flags that show us exactly how these trades are structured to obscure money rather than actually invest it. Take mirror trading, for example. This is where you execute identical or offsetting trades at the exact same time just to move funds from one jurisdiction to another without taking on any real market risk. Or currency conversion. This is a sneaky one. A bad actor buys securities in one currency, sells them in another, and basically uses the stock market as a backdoor foreign exchange to totally bypass standard FX monitoring. And then you've got in and out trading. These are rapid, high-volume trades that rack up big broker fees but make absolutely zero economic sense for a real investor. To ground this in reality, the FCA's 2025 review points straight to the Deutsche Bank mirror trading scandal. It's the ultimate cautionary tale. This wasn't just theoretical. We're talking about $10 billion in illicit funds moved out of Russia. How? By buying Russian equities in rubles over in Moscow and simultaneously selling those exact same stocks in dollars over in London. Because the trades perfectly offset each other, there was zero market risk. It was literally just a multi-billion-dollar pipeline, moving dirty money right through a respected Tier 1 financial institution, all under the cover of standard institutional trading. Which leads us to a really critical and frankly terrifying question for every compliance officer out there. If a transaction has the right commercial form, speaks the correct market language, and leaves a totally clean paper trail, how do you even know it's a crime? Answering that requires a massive, fundamental shift in how we monitor behavior. That brings us to Section 5, Catching the Market Launderers. Let's explore the smarter controls we need to finally pierce this illusion. Institutions absolutely must abandon that old retail cash threshold mindset and shift towards specialized pattern recognition. You need a mature control framework that does deep beneficial ownership analysis, meaning knowing exactly who is actually pulling the strings behind that complex corporate veil. Firms have got to perform what are called commercial coherence checks. Basically, you have to sit down and ask, does this client's trading strategy actually make financial sense? You're looking for unexplained transfers, totally sudden shifts in strategy, or the bizarre use of low-risk instruments just to shuffle money around. And let me be clear, there is zero time to waste here. The FCA has explicitly placed money laundering through the markets right at the absolute top of their 2026 wholesale markets supervisory agenda. This is an immediate priority right now. Senior management needs to map exactly where this risk sits within their specific business lines. And even more importantly, the front office staff, the ones actually executing these trades, they need to be trained to spot this. They have to realize that highly sophisticated, totally normal-looking institutional activity can still be 100% criminal. Crucially, you've got to fix the internal organizational structure. The European Securities and Markets Authority, in their market abuse regulation review, made it clear you cannot fight this threat in isolated silos. Schemes like mirror trading severely damage market integrity, even if they technically dodge the classic legal definition of market abuse. It requires coordinated, cross-team surveillance. I mean, if your anti-money laundering team and your market abuse team are sitting on totally different floors and never talking to each other, you are leaving the back door wide open for criminals. So, I'll leave you with this final provocative thought to consider today. Take a hard, honest look at the frameworks protecting your firm. Are your controls actually catching criminals, or are they just monitoring the illusion? Because in the complex, high-speed world of global capital markets, a magic trick is only successful if the audience doesn't know where to look. Thanks for joining me for this explainer, and remember to always keep questioning what you see on the surface.